Welcome to Tuesday's Commodities Corner. I'm Elaine Stenson. This year, gold has climbed 9% on signs of a faltering global economy, while Russian President Vladimir Putin completed the annexation of Crimea. Gold futures fell to their lowest level in 5 weeks as investors considered diplomatic tensions between Russia and the West. Ross Norman, CEO with Sharp's Pixley in London, joins me on the line now. Ross, are you surprised that the conflict has had this impact?
Well, not really, insofar as gold is a safe haven, and it always will respond to geopolitical tension, and we've seen that time and time again. It's always difficult to nail down what's going to motivate gold day in, day out, week in, week out, but geopolitical tension is always one of those things that will trump all other issues, with a possible exception of the US dollar as a motive for gold direction. So, in short, no, I think gold's doing what it should do.
How do you think the markets will react when the Russia-Crimea situation eventually subsides?
I think we're already perhaps seeing a little bit of a discounting coming on at the moment. I don't think people necessarily believe that we're going to go to war, or this is going to become too protracted over this issue. So in short, I think we've seen some weakness already. I think the possibility of a de-escalation of tension there is already in the price to some extent. Gold tends to respond in real time to these issues, so maybe a tad weaker, but not an awful lot.
Will the EU and US sanctions on Russia have any bearing on gold prices?
More so on palladium, of course. I mean, the natural way to respond to this crisis is through the platinum group metals, where, amongst other things, Russia is one of the major producers there. Being the largest producer of palladium and the second largest producer of platinum. So, amongst the car makers and other industrial players, they will be concerned by these sanctions and the possible retaliation by Russia. The only issue that I haven't touched on is the possibility of the US dumping US treasuries. And of course, they're a large holder of those. And the weaker dollar, of course, could prompt a significantly higher gold price as well. So there's a possibility on gold and more of a certainty, should we say, on palladium.
Ross, gold tends to struggle during periods of high interest rates because it doesn't earn interest or dividends, unlike stocks and bonds. What impact has the prospect of the Fed raising interest rates sooner than expected had on gold prices?
Yeah, I think that was quite significant, really. I mean, I think Janet Yellen had a pretty positive first outing as the Fed head, and the possibility of rising US interest rates certainly took the shine off gold at a time when it was showing significant price increases. 14% year to date when that announcement came out, and we lost about 4% of that 14% gain. So yes, unquestionably, the prospect of higher interest rates in America has taken some of the shine of gold.
Ross, does this concern you at all?
Well, I don't think so in particular. I think she may have, I think the media, shall we say, have slightly overextended the argument about interest rates rises. There are still some concerns about momentum in US growth, and I don't think anyone is entirely convinced there's strength or momentum in the growth. So I think it's more of a, shall we say, a hope than an expectation that rates will rise.
Okay, Ross, thanks for that, and thanks for joining me on the line today. And that's all from me for now, but Ben Jones will be back with more from Commodities Corner on Thursday. Until then, bye for now.